Transhuman Capital. We are specialists in private equity, venture capital, mergers and acquisitions. Collectively, over the last 12 plus years, I've worked, in Bombay as well as in Delhi with brands like KPMG, Ernst & Young, managed to close transactions more than $500 million. And across different stages, so I've worked with large corporates like Tata's, Mahindra's, as well as new ventures in terms of emerging technology companies. So the spectrum is quite wide, and we have helped companies raise as pre-Series A, Series A rounds, which is $1 million, all the way up to $30 to $50 million as well in terms of private equity. Now I'll touch upon this. I'm going to be sharing the presentation that we have. I hope it's visible to all. Yeah. So now I'll spend a minute about the agenda. So this initiative, as we all know, is how to raise venture capital or private equity for startups and emerging ventures. And how we have structured the agenda for the day is that we are going to be talking about the challenges faced by startups or early stage ventures for their fundraising requirements. Then we're going to be talking about who are the relevant investors, because that's an equally important thing to know, that not every investor could be interested. And thirdly, we are going to be talking about venture capital, the guys who invest in early stage ventures, and discuss the pros and cons as well. Then what do investors look for in startups, how to go about the process, and that's how we're going to be concluding the session. So now, what are the challenges and how different ventures go through the cycle? So one is, of course, as all of you may be able to relate to it, is that there is a limited access to relevant set of investors. There is in India an early ecosystem of collateral-based financing being prevalent in India. So what it effectively means is that unless we have securities or cash flows to support financing, it is difficult to raise any debt funding, which effectively leaves room only for angel or equity funding to cater to the requirements of emerging ventures. To top it, many entrepreneurs are not finance savvy. So many entrepreneurs are technology friendly, technocrats. Many of them are operationally sound. They know their business, they know how to sell, they know how to market, they know how to make sense of their operations. But finance is something which may be tricky. Another point is inadequate strategizing and validation. So effectively, creating a business plan is seen to be a rather easy task, because that's what every one of us gets to know about during our graduation or during our MBA program. What does it take to build a business plan? But more importantly, does the business plan articulate what you have to communicate to the investor in a manner that the investor can appreciate your business? And that is where professional help helps to say and communicate your differentiation vis-a-vis doing it independently as a standalone entrepreneur. Valuation, again, a tricky affair, because how do you value companies which are in the early stage of growth? Whether it's in terms of revenues, in terms of product, in terms of future projections. Many of them are disruptive, so there are no comparables or precedents in the market which can be benchmarked. And lastly, investors have become wary of sorts. So given the past precedents, as you all would be familiar with the press releases as well as the media, that the first phase of startup boom has also gone through a metamorphosis in terms of restructuring. Valuations had gone through the roof. There were several unicorns created out of India in terms of billion-dollar plus businesses. But over the last 6 to 12 months, we have seen a correction of sorts, because investors are now questioning the valuation as well as the growth which ventures are witnessing. So it's an important time for most of the entrepreneurs to reflect what is the best way to communicate in the right manner to the relevant investors. And that's what we're going to be touching upon today. Now, if you look at the next slide, who are the relevant investors? Now here, if you look at, depending on the stage of your venture, the investor relevance can be figured out. For example, there are startups who are not yet ready with the product. They could be a pre-revenue company. Then there are startups who are making revenues but not profitable, they're burning. So they are pre-profit companies. And then there are ones who have stabilized, who have reached certain scale, who have reached certain traction, who have achieved proof of concept or market product fitment, and are ready to take on growth capital as opposed to a risk capital, which typically the VCs looks at. So we have through this chart, you can see on the x-axis is the company life cycle, on the y-axis is the growth of financing requirement. So when we are in the early stage, like an R&D or a startup stage, the first two stages, uh, that's the most difficult part, because the number of takers in the market are very limited. And the reason, as you can appreciate, is because the risk of investment is the highest for an equity investor at that point of time, because no POCs or proof has been done as yet. But there is a market opportunity, there is a team working behind it to address it, and there is some works being done by them to develop it. So this is where typically an angel investor or a seed investor comes into play. And you might be familiar with names like Indian Angel or Mumbai Angel, the 5-minute startup. So these are some of the usual guys who come in at the angel level. Post is when we are looking at traction. The company has spent some time, is revenue generating. It may be burning, it may be loss making. It is yet to achieve a break even, but there is a scale. There is a proof of concept in terms of customer product fitment and acceptance, and that is where we talk about venture capital. And typically that comes at a pre-series A, series A round. So what I mean by a series A or pre-series A is that typically these investors like to see some traction, some proof of concept already done, and now the venture requires to launch it in an expansive mode. So maybe it wants to develop its marketing strategy and deploy a lot of money towards acquiring customers. It could be newer markets, it could be upscaling what they are doing at a larger level, and that really qualifies for a series A investor. Typical fund requirement here could vary anywhere from $500,000 for pre-series A to anywhere up to $4 to $5 million for a series A investor. And as you might be familiar, some of the names that come to mind are Sequoia Capital, Matrix, Bessemer, SAF Partners, Excel, and many more. So in total, India may have more than 100 plus investors in this venture capital space who are active and who are actively looking for startups to invest in. Then we come to private equity, which is the growth stage. Now, what it assumes is that at this scale, once you are already past the early equity risk, and your venture has reached certain revenue scale, it has most likely achieved a break even. If not a break even, at least the unit economics is making sense. It has achieved a steady state of unit economics. And that is where a private equity investor, which typically invests anywhere starting with $5 million roundabout to anywhere up to $50 million as well. And these are growth investors. So some of the usual names that can be seen here, like the Bain Capital, Blackstone, Carlyle, and India has more than 150 plus investors focusing on the growth and private equity stage. Then eventually we come to the maturity phase. Now this is more from an exit standpoint for investors as well as for entrepreneurs. That after several rounds of fundraising through venture capital, private equity, where do we see an exit in the next 5 to 7 years? And that is where the maturity curve comes in. That now the financial risk is pretty much mitigated. What is left is for investors and entrepreneurs to evaluate their own journey and expectations from the process. So the pure play ROI based investors would like to seek an M&A or an IPO to exit. Many times entrepreneurs also believe that the value they were looking at to build has been achieved, and thereafter someone of a strategic kind could take over and run the show, which is why you would see some of the deals that have happened in the M&A side in India as well. For example, how Ola acquired TFS, Taxi for Show, or Snap Free Charge, or some of the recent transactions that have happened, like Quicker acquiring Common Flow. So many of these transactions are where the entrepreneurs believe that they have taken their best bet and have taken it to a level where a larger strategic player can acquire and take it to the next level. What are the pros and cons? Now, of course, one important question that comes to any entrepreneur is, do we need capital? Yes, I don't see anyone saying that we don't need capital, you know, because that goes hand in hand with the growth requirements of any emerging venture. But what comes with it is the question to be asked. You know, it's easy to get swayed by the fact that it has become fashionable to be a funded venture. But what comes with it is also to be known and done in a proper manner so that it ends up into an amicable relationship with the investor eventually. Because post investment, there is a long way and a journey to be, carried forward. So the advantages, as we all know, and for the benefit of people who might be new to the process, is that as a venture capitalist, to be a partner to your venture, you have a patient capital. So, if you go to a lender or an angel investor or an HNI, they may look at a shorter time horizon because that's the capital that their cycle works at. But in a VC or a PE firm, the cycles are more prolonged. They don't expect monthly, quarterly, or annual returns. They are betting on the future, which can build over 4 to 5 years together with them. So what they're betting on is shareholder value enhancement. So it's a patient capital. Second is industry experience. For example, they bring a lot of experience through their own teams, because these people have their own network, contacts, portfolio companies, India, internationally, which can add value besides the capital that they bring to the table. Fourth is extra credibility. So this means that if you are backed by a known investor, your valuation and your future growth projections are more credible to any subsequent investor or in general to the market. And eventually the smoother growth trajectory. So effectively, the hardest bet is the pre-series A's. Once you raise your series A, the journey becomes much more smoother, because your follow-on investors, whether it's series B, C, D, can already know and count their bets in terms of what will happen, because with each subsequent stage of funding, your risk is getting mitigated in terms of venture capitalist outlook on the growth of the company. In terms of disadvantages, this is where I'd like to mention that there is obviously a lesser autonomy in terms of decision making. That could be good, that could be counterproductive, depending on how the investor and the founders have the chemistry and the vision of sharing that future vision. So we have seen, for example, how it happened in housing.com. There was disconnect. It led to eventually wrapping of the such a large and a growing and a well-funded venture, because there was no consonance between the investor and the founders in terms of where the company is headed. On the other hand, most of the times you would see investors working as passive, supporters of the entrepreneurs and letting the entrepreneur run the show, and which is what most of the well-funded companies have been able to take their resources for. So while there is a lesser autonomy, but what it means is that you have a larger team at the top level who can take decisions, whom you can count on as a soundboard. Stringent contractual terms and conditions. Now these are important clauses to be vetted at the time of closing a transaction with the investors. That are we overcommitting ourselves? Are we being fine? And not only looking at today, but also the future. Because many of these contractual terms do not matter at the time of raising money, but they do matter at the time of seeking exit for the investor. And that is when one, as an entrepreneur, comes to realize, okay, did I commit to that? Did I look at buybacks? Did I look at tag along, drag along clauses? So there are some conditions and terms that come along with the shareholder agreement, and that they need to be vetted properly at the time of signing the deal and raising money. Expected ROI. So this is important to have the right expectation of what ROI or return on investment you can generate. For example, a Series A investor might expect multi-bagger returns, maybe 5x, 10x. But if you believe that you cannot generate, you may not go for those kind of investors. You may only go for a realistic investor who's looking at that 2x story in the next 4 years. And there are investors who have different appetite in terms of ROI. So it's important to know that as well. Potential conflicts of interest. Now this is the disadvantage in the sense that sometimes investors do a lot of diligence before they commit money, and it is important for an entrepreneur to know that most of the investors are non-committal before they close a deal with you. and they might be talking to many of your competitors or potential opportunities in the market. So there should not be any situation where that USP or differentiator or the IP which we are building creates a potential conflict of interest with any of the portfolios or investing companies. Now, what do investors look for in startups? Because that's again an important question to ask. That when you are developing a pitch or you're looking at raising money, it's important to also understand what do investors think or evaluate when they look at putting money behind the ventures. So some of the key criteria, and this is based on our interactions day in day out with investors across number of transactions and across number of companies that we are supporting. Some of the key areas they look at is market adoption risk, that is how suitable and what is the kind of traction your product or services are getting from customers in light of the competition. Implementation risk, this is how implementable is the plan, because it's easy to project numbers, it's difficult to meet them. So VCs also are well versed and have a view on different sectors, so they want to know that is it too aggressive, is it aggressive, is it conservative, and therefore they judge also what is the DNA of the entrepreneur, the team that they'll be backing, and does it gel with them. Scalability, is there enough room for growth? That you may be growing well, you may be doing month on month or quarter on quarter 50-100% growth, but if your entire market segment ends up becoming a niche segment, and what I mean niche is subjective, because certain sectors like e-commerce, even if it's $100 million segment in e-commerce, it's not seen to be as scalable. But if you have a $100 million IoT or an enterprise SaaS opportunity, that's still scalable. So it varies, but the end point is that can it become as big for you to take it to a series B, C, D rounds? If not, then there is a chance of getting neglected as a subscale company or a venture. Sustainability, what it means is that how differentiated and competitive can your venture be, and not only today but in the longer run, and what is it that your venture is doing to ensure that it remains sustainable. Ability to generate superior returns, so that's more about the ROI and the valuations. What is the entry price that you are offering to them, which is a function of how much stake you want to dilute today for the ask that you're looking to raise money for, and what is the valuation that it can command in a few years down the line. So there are different methodologies to value the company, and to make the deal sweeter, one can look at depending on how much of criticality is involved in closing around faster versus waiting and doing it later. Exit risk, so this is more of from a VC perspective, that they want to ensure that they are in a sweet spot wherein 4 to 5 years down the line, if not earlier, they can have a amicable exit, and typically by way of another VC or a PE coming in or looking at M&A, and which is where entrepreneurs should also spend time and see that while they may be here for the long run, but for the entrepreneur or for the venture capitalist, there is a time bound return that they have to generate for their investors, and we should be realistic in saying that what is a good enough time frame for them to secure and exit their returns. Now, how do we go about the process? So these are summarizing some of the takeaways from our years of experience and our interactions with entrepreneurs, with venture capitalists, with the whole ecosystem. So I would like to say a few important points here. That set your expectations right. Seek only what you can amicably deploy in the time frame that you're looking at. Basically, bite what you can chew. So if your capital requirement is $1 million, don't pitch for 2 or 5 million. If your capital requirement is $5 million, don't pitch for 1 or 2, because that won't help you gather the right muster. So effectively, it's important to assess how much we need, for what time frame we need, and be realistic about it. The other is also a question of why do we need the capital? To my mind, the two most important questions one should ask is, do we need it for scale or do we need it for sustainability? When I say sustainability, it means do we want to achieve break even and get a unit economics sorted out through this ways? Now, typically the ventures who have scaled up need the capital mostly for the sustainability part because they are yet to get there. And the ventures who are sustainable, who are profit making, needed to scale up. So we should be clear in our minds as entrepreneurs, as business owners, what and why we need it for. And then what are the terms in terms of dilution? So, it's easy for someone to overvalue and pitch like, okay, I don't want to dilute more than 15%. Because I want to eventually drive my boat. In any case, I don't want to drive more than 40%. But do understand that in the longer journey, whether you're looking to make it an organization and build an institution, or are you looking to monetize it and trade it in the short term? If you're looking for the long run, you will realize that the companies which have IPO'd have always led to the founder becoming a minority investor eventually. So dilution as such may not be that much of a concern as long as your intent is clear and your valuation also should be justified, that it should not also lead you to over dilution at a wrong price point, which is where the valuation comes into play. An effective business plan should also aim to articulate what you want to convey to the investors in the language they speak, not in the language we speak. So which is also a challenge, especially if entrepreneurs are not very finance savvy or not very investor savvy, and that's where a role which we also play in terms of making it more professional, because investors are looking more at frequently asked questions or checklist that they have when they initially decide to go or no go, and entrepreneurs, which is understandable, may not know what exactly goes behind that algorithm in the mind of the investor. And they of course want to pitch it to the best of their abilities, but what it ends up is sometimes it becomes a marketing pitch as opposed to a collective investor pitch. And investors are way I would say more interrogative than customers, so it ends up not meeting their mark many a times. So take professional advice, engage a firm if you like so, to ensure that you get the right message across in the shortest possible time to a variety of investors. And that's where firms like us also play a role in terms of being investment banking partners. Connect with the right set of investors. That's also equally important because as entrepreneurs we have our own network. We may be knowing a select few investors because we are networking. Some are our peers, some are alumnus, some could be our mentors. But that's not the end of the thing, because if you go only through familiarity, you may not end up getting the right set of investors for your venture. What is important is also getting people who may not be familiar to you, but who may be right for your venture. And that is where, again, seeking help of an outside agency helps, because we are in the market day in, day out, having a network of more than 250, 300 investors that can be made visible about the deal. Understand the terms that you agree with the investors. So this is important from the perspective that, like I mentioned earlier also, what are the terms and conditions that are going in the term sheet, what are going in the binding agreements, which are shareholder agreement, share subscription agreement, if it's a joint venture agreement, because eventually those will play out during the course of the journey post money. And lastly, I would say, getting funded is not the end of mission. Rather, it is the start of an exciting and challenging journey. So it's important that the milestone for raising money is not to raise money, get funded, and then have it as a significant achievement. What it effectively means is that there is more onus on the entrepreneur and the team now collectively to share that responsibility and take the venture to its next course of journey. Of course, it acts a lot of oxygen and ammunition in the hands of the entrepreneur to implement what they have in mind, which otherwise would not have been possible had we been continuing on a bootstrap basis. But it is equally important to be realistic that what with this raise can be achieved in the time frame that has been committed or discussed or agreed with the investors, and which is where one should be clear that how long and how far can the journey be together, what milestone can be achieved, and what should be our deployment mode, and what could be our expansion strategy. So I would say these are some of the summary of points which can be shared for now. Of course, there are specifics as one goes, which again depends on case to case, depending on which investor and what sector and what venture is being advised. So that's about it from my side in terms of the process side. In terms of DSIM, you already are aware there are one of the most advanced digital marketing course in India, and if you have any interest, you can visit the site. Kunal, as you know, is already started the session. And about myself, this is a summary of what we are. So I already shared about myself and Trans-Human Capital. We are one of the leading players who are focusing on pre-Series A, Series A, and Series B, basically venture capital and private equity market. So that's about it from my side, folks. Happy to take on any questions or discussions that you may have. I can see that there are some questions, and
Okay, so
so if there is
thank you so
anything,
much, Gaurav, for such a good session. For me, it was very, very informative. I really learned a lot, appreciate, and I'm sure, all our attendees, they have a similar view. So, guys, we have opened this session for queries. If you have any query, whether it's your business, you want to understand, whether a business idea is good enough to generate some cash funds, or you need to have something on paper financials, you need to have some turnover. So please, whatever queries you have, please feel free to ask Gaurav. So Gaurav, we do have some questions. Uh, so we have a question by Niranjan, and Niranjan says, how do we handle the valuation conflict, as there will not be any such big firm, that is investment banking or investment banker involved in valuation, and there is no long history of business operations as well. So you can check it at your end, Gaurav.
right?
Niranjan has asked this question, please.
Sure. Yeah, yeah. Thanks, Ranjan, for the question. It's an interesting one and a relevant one for especially early stage companies and startups. So, here the valuation conflict, as I understand, you're suggesting is because there's not much history in terms of data points that can be substantiated. At the same time, you may not be in a position to engage in IB as well because it's early stage. So in that scenario, I believe it is more like a pre-revenue or a concept or a seed level investment. And the best way to access there is to look at some market comparables and look at how companies in your sector or related have been able to secure money in the first round. A good guiding principle is that typically in the angel round or so, or seed round, people look at more of the market, the team, and the product or service you're building, and take a bet on it. It's not so much about financials there, but they would still expect to have a significant up to a significant minority stake, which could mean anywhere from 15 to 25% stake in the first round itself, so that because they are betting on at the first level of the stage. But in terms of ask, you could look at also what is realistic to take you to a next level of investment, which could be a pre-series A round or a early angel fund round. So one should not look at a very high raise in the first round, because you will end up not getting the valuation when you're talking about the first seed level of investment.
Okay, I hope Niranjan you understood what you were seeking to understand. So next question we have from Rajesh. If you can please, Gaurav, look into it.
Yeah. So I can see, I think he's mentioned that venture capital investors are normally investing only in the e-commerce and internet startups and not so much on the traditional businesses. Is it true or false? And if true, then why? So here, I would say, Rajesh, that it's a good question that it looks to be the case, given that most of the well-funded companies are coming from the internet or consumer e-commerce space. But there are a different set of investors who focus on non-tech or e-commerce businesses also, and but they are not as much in the limelight because they are more of either conventional private equity investors, or they are more of family office funds who look at businesses which are profitable, which may not have tech part of the deal, but eventually they are there to make money, and any business with or without tech which can deliver their ROI is up for evaluation for them. So here, what I mean is, if you look at, there are investors who are funding restaurants, who are funding, fashion labels, private labels, which may not have any tech marketplace, but this could be pure play labels itself. So many of these companies have been able to raise money, and the only challenge there is those investors are not betting only on scale. They're betting on unit economics and validation of few markets. So if you see e-commerce or internet startups, the trend that has been was to bet on only the macro story and bet big on what can grow really on the scale part, how many cities and how much of a brand can be built. But of lately, because of the correction that has happened, even the Series A investors have started looking differently to ventures who may not necessarily be on scale, but also looking at unit economics.
Right, and just to add to that, Gaurav, yes, we do have, as you said, that we do have some private equity firms and also VCs who look into the traditional business environment, traditional business setup. But yeah, I also personally feel that VCs, they on large scale, they prefer e-commerce and internet related companies, companies who can scale up fast. And this is the trend. This is what we see, that the reason is because the companies that are online, they're able to scale up their business very fast. I'll just take a minute and would like to cite an example here. Suppose, yeah, I mean, let's say that a company like Coca-Cola, a big MNC, a very big brand. I think in terms of brand valuation, it is rated in the top five companies in the world. But it took more than 125 years for Coca-Cola to reach their current brand awareness. And if you talk about in comparison, if you talk about the internet related companies like Google's and Facebook and Twitter, and I would cite Indian examples like Flipkart's or Byju's. Byju's is a company again which has raised the maximum number of funds last year in 2016 in India. So the reason why VCs, they prefer internet-related companies or companies that are more technologically advanced or based out of internet, who can easily scale up their business online, is because their reach to potential customers is very fast. So I hope, Rajesh, you received your answer, what you were looking for. And we have a lot of questions. Unfortunately, we will not be able to take each and every, but yes, definitely we'll answer a few.
Yeah. Also, I think there are some questions I am seeing. Like Prasanna Gotani has asked that what are the documents required for preparation for convincing venture capitalists, and does it require financial market projection? So here, Prasanna, I would like to say that yes, whenever you are going to only seed or angel guys, they may not require too much of a detailing. But when you are looking at any professional investor, which means a fund or a VC, they do require a proper business plan, because much of the valuation in the story is to be unfolded once the venture raises money. The history doesn't make that much of a sense, but the future does. And the business plan or your financial document or projections are the only basis, besides the discussions, that give them a view of what they will be in once they put the money behind the venture. So we do require a investor memorandum, we do require a valuation model, and some of the projections supporting the requirement of funds, as well as the valuation basis on which you want to dilute money to VCs.
Right.
And then I think there is one, which is coming in terms of, you know, Anurag, who is saying that how to pitch VCs for internet-based fashion label startup. So I would say, for any of the queries that you may have regarding, the session today in terms of, follow-ups, or if you're looking to engage an agency, then we have our website also. You can refer to it. It's called transjuvencap.com, and that is more from any one of you is looking to engage a professional firm like us to help you support a venture capital round. Uh, Besides that, I would say that as far as the process goes, if you believe that the venture is early stage and may not be able to afford or engage an agency, then you could look at a smaller requirement from angel funds or seed investors who are also able to evaluate, but there the fund requirements are lesser. Typically, those are for pre-revenue or early stage companies who have fund requirement not more than 100 to $300,000. So that's the kind of ticket size that they can support. But after that is when someone like us can help you.
All right. So we still have a lot of questions left, but unfortunately, time is a constant. We don't have it much. So I think Gaurav, that should be all for today. And do you have anything else to share with our subscribers?
Okay, I think it was really nice of scheduling this webinar, Kunal, and thanks to DSIM. And thanks all of you who have participated today in this discussion, and thanks for making it interactive and asking questions. Happy to take on questions offline and based on your interest as we go along. And thanks once again for giving me the opportunity to address and be of some help in terms of addressing your questions as well as areas of interest. Thank you.
Thank you, Gaurav, taking out time from your busy schedule. It was pleasure to have you here, and I'm sure all of us, all our attendees, they shared my feeling. So, guys, those of you who joined late, or I can already see a lot of PPT requests. Well, you don't have to worry about PPT. What we are going to do is we will be sharing a recording of this session with you. And as you know, that every Tuesday, DSM delivers a masterclass, a Mangalvar masterclass, where industry experts they join in and they share their valuable experience. So we have a lot of recordings. If you talk about the recording of this session, it will be emailed to you by tomorrow. And if in case you would be interested in the recordings of the previous webinars, Mangalvar masterclasses, then I have just sent you a link. Please check the questions tab. I have sent you a URL. Just click onto it, and you will be able to browse and access all the recordings of the past webinar. Also, those of you who would be interested to increase their digital marketing knowledge, all you have to do is just go to YouTube and go to DSIM channel. So I'll just share a URL with you wherein you can access
All right.
recording of DSIM's demo session.
And only mode.
Hey guys, good afternoon everyone. So this is the session, guys. I've just sent you the YouTube link. You may access it whenever you have time, and if in case you would want to know more about how you can scale up your business, how you can use digital marketing and reach out to more prospects online. So thank you so much once again for taking out time and participating, attending DSIM's masterclass. Thank you. God bless you.
Yeah, thank you.